Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on March 13th, 2023. As a reminder, and I'm going to get a little bit of detail about this, our next Options Income Blueprint live trading session is tomorrow at 11 o'clock. For those of you in Income Madness, we're on at 12 o'clock. They'll be back to backs. I'm going to go over our trades and results from last week, and I'm going to not revisit, but continue a discussion that there's a need to trade like at times like this, to trade like a trader, but to think like an investor. Let's go over results, and then I want to talk about what's happened in the last 72 hours or 96 hours in the real world. We closed trades, very nice rates of return. Blackstone, the timing was propitious because of what went on in the financial sector at the tail end of the week, and the trade desk, which is one of our favorites. Very high volatile, rich and premium stock. Same thing. We were able to exit the position before some of the tumult hit the market. As always, we're rolling our core positions and generating cash. And I want to stop here for a moment. I got an email from a member in one of my services with tales of woe about all the money that person has lost. And the back and forth was, have you closed the positions? And they said no. And so I said, you haven't lost any money. And the back and forth was predictable. I've seen it for 10 years. Well, my broker screen is showing lots of red. And I said, it should be showing lots of red. The positions are underwater. But that's why I want to go to trading like a trader and thinking like an investor in a moment or two. Is especially in times like this, you can't look at your portfolio on a Friday and get a case of the nerves. If that's the case, I suggest you buy bonds or real estate. And oh, wait a minute, bonds have been hit hard, which is why we're having a banking tumult, and real estate is beginning to flatten out. My point is this: when you invest, there will be time-sensitive downturns in anything that you do. This is not an apology or a regret about recommendations I've made. I stand by all of them, and I like all of them. This is about the mentality you need when you're going through something like this. Now look at those numbers. That's real cash, folks. These are the numbers you need to keep in your head. If you see flashing red, if you read headlines that the financial world is ending, that's probably on websites desperate for click-throughs. And remember that when we crashed, the NASDAQ was down 37% after the previous administration went from, oh, we're never shutting down, to, oops, we're shutting down, and caught the market by surprise. Every presentation I did, maybe for 3 months, no, maybe for 6 weeks, said, always had the last slide was the same. I will continue to remain annoyingly calm. If you can't stay calm and think clearly during these periods of not just a market sell-off, which was not major, but it was noticeable, combined with headlines that might evoke fears from 2008, 2007, 2009, this isn't the place for you, because we are here thinking like investors, and you can see those rates of return in the cash that we came in. This was a good week, and cash week by week, accumulated week by week, spent week by week, reinvested week by week, over time beats a bear. The math is very simple. It beats a bear. Now let's talk about last week. It is all about headlines, and the headlines were actually very different. Just to get sort of like in The Wizard of Oz, the man behind the curtain. I usually do these on Friday afternoon after the close because for a couple of years now, since Twitter became the voice of America, since stopped being voice of America, I don't really worry about the weekends too much. This was a weekend to work. So SVB Financial went under, okay, and people thought that they'd have a buyer by Monday or Tuesday of this week. The FDIC came in and said, nope, we're shutting you down to prevent systemic risk on Saturday. And the banking sector had already sold off. Why, if you haven't read the headline, or haven't read below the headlines? It had $200 billion or so, more or less, in assets, and it screwed up its bond portfolio, and it had to write off on paper losses in the value of bonds. And this is worth an explanation. This update's going to be a little longer than the typical one. A bank has to have a certain amount of core capital to be within regulatory guidelines. Part of that core capital, of course, can actually be equities of a certain quality, and could be bonds. Now, the bonds don't lose money if you don't sell them. They lose in value, but they don't lose money if you don't sell them because they go to maturity. But as interest rates go up, the bonds you hold with a lower interest rate go down in value. Over the past few months or the past year, $650 billion in banking core capital in the United States has been wiped out on paper from this effect of interest rates going up. But with Silicon Valley Bank, they support a lot of unicorns, billion-dollar tech startups, keep their money there, venture capitalists, and they're all drawing down money because of delayed IPOs and burning expenses and increased costs. And so they had to actually sell some bonds and take a capital hit, and people didn't want to give them any more capital, so they needed it to sustain the numbers of their core capital, or they were out of compliance with regulations. The reason it was a surprise, and thank you to a member who pointed this out, was the previous administration snuck into a bill somewhere. It used to be that if you had $50 billion or more in assets, you had to provide regulators with insight of declining value of core equity or core support for your bank, and keep them informed about what was going on about withdrawals and whatever. But that was bumped to $250 billion without anybody noticing it. Some lobbyists must have made a lot of money on that, and maybe even some senators and congressmen. And the bottom line was this was a surprise because there was no regulatory constraint that they had to report a growing problem. So it was a surprise, and Wall Street was surprised. So at the same time, crypto crashed because, in my opinion, of leverage across the bond market, across the equity markets, and crypto, and also may have just been crypto on its own. So what happens then? There's a bank in New York, Signature Bank. Now that third headline is wrong. Signature, but I want to show you the impact of headlines. Signature Bank, which is a New York bank, mostly caters to real estate developers, escrow accounts for real estate, large commercial real estate deals, healthcare providers, law firms, service firms. And they had $16 billion exposure to crypto they picked up after the failure of FTX. Well, they were beginning to have liquidity problems. New York bank regulators, which are sometimes tougher than the FDIC, come in. With the FDIC, they shut them down. And over the weekend, the Fed announced that they will bail out these banks. It's going to be a political brouhaha, and I'm assuming 98% of what you will read on Politico or The Hill or Axios or stuff coming out of Capitol Hill will be 100% flat out lies. The Federal Reserve is going to use the statutory power it has to make sure that there's no systemic risk in the system, and that the banks have liquidity and people get their deposits back. Not $1 of taxpayer money will be spent. There's an emergency fund for this. There's a part of Federal Reserve regulations that allow the Fed to do this. So if you hear people screaming that this is a giveaway to the banks on one side of the partisan divide, and if you hear others screaming we should let capitalism do its job, they're both lying. And you need to keep that in mind because it affects how we trade and the market. What I'm suggesting is there's going to be a lot of bounce going on, and there's going to be a lot of noise, and a lot of sound. So one of the things this obscures is that the payroll increase up to 311,000, expected was 225,000 on Friday, was seen better than just being a hot number. A hot number, the market should have sold off. In the morning hours on Friday, the market did not sell off because there were things inside this report that indicated things were slowing down, which is what people want to see on Wall Street because they think that means the Fed will not raise rates as aggressively as feared. So this was obscured uh, by real potential risk if the Fed hadn't stepped in. And the risk is in regional banks. The risk is not in the banking system as a whole. And that's what I'm going to talk about right now. So, if you're trading like a trader, maybe we don't even trade tomorrow. If the banking sector is completely unsettled into tomorrow, and we're hitting 38.50 and then maybe going down to 36.50 on the S&P, it doesn't matter if we take a breath for a few days. But if you think like an investor, we've already seen there are opportunities coming up. If you're not in the Bank of America trade, for example, the stock's on sale. It may go down another 10 or 20%, but the stock is certainly on a value basis on sale. And headlines and this kind of market tumult does not impact companies, with a couple of exceptions, which are out there in some smaller banks. Up until 2008, the banks could count their own equity as core capital, and that got them in trouble when the value of their stock went down. And this is not an issue with the mega banks and the people that really run the system. I mean, a half a dozen banks control God knows how many percentage of assets, 15 trillion or something like that in the United States. We trade companies and we trade the real world. To that point, in the real world, the banking sector is much, 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 much stronger than 2007, 2008. If you're new to this service, you haven't heard me say, I ran a short service, pure speculative service, everything. We were trying to double our money, buying puts. And we did 21 money doublers in a row during the financial crisis, but we started in 2007, a year before it made itself really painful, just by doing simple math and simple research. The Silicon Valley Bank, and to a lesser extent Signature, was unique due to the nature of its deposits. With Silicon Valley Bank, I explained, with Signature was that foolish plunge into getting $17 billion in crypto assets. I believe the spillover will be short term. It'll be confined to equity markets and not the banking system itself. I feel very strongly about that. That said, there are banks that are down 70%, that will be down 60, 70% at the open, and they're big regionals. They're big regional banks that are exposed, and they're exposed to that. They may have 100 billion or 50 billion or 60 billion dollars in assets from companies that say, well, I'm not taking any chances. I'm not going through this nonsense. I'm going to move my money to Citibank or to JP Morgan or to Bank of America or to Wells Fargo or to Morgan Stanley or to Goldman Sachs, the big mega banks that are nowhere near this kind of an issue. Now, regional banks are typically too illiquid for us to trade, but there's a very, very liquid, and I'm sure it's flying in terms of liquidity right now, is the KRE, and we traded it successfully in the past. That's a screen capture at 4 o'clock, after 4 o'clock on Friday. It's totally different. I assume it's going to be way down today, but I'm putting this on your screen, on this screen. I'm putting it on your radar because I want to start doing that anyway, because of the nature of what's going on in the market. I think on Monday morning, you need to understand, to know, to look for yourself about what I might be trading with you this week. And the question is, should we trade it this week? It depends. No promises. If it stabilizes, if investors come in, if the market puts the headlines behind it, let's say by Tuesday or Wednesday, sure. If not, we just keep watching. So in the real world, for those of you, I got a question about crypto this weekend, so I put this in. In the real world, crypto has no intrinsic value. The value of crypto is the last person who purchased it. So in economic terms, it's called the bigger fool theory. And now the collapse of the bank that exposed itself is quite real, thank you. And so this is where you start seeing potential contagion in the financial system, and that's why the Fed stepped in. And I do believe it could spill over into equities. It is right now. And it may continue, but I do see it as a multi-day and not a multi-week event. In the real world is what I'm concerned about, and we may not be able to do anything with it this week because of what's going on in banking. But it was a hot report, but only sort of a hot report. The headline was a hot report, 311 versus 225. There was a small uptick in the labor force participation rate because of higher wages, which is actually very good for the economy. It means more money to spend. It may not be good if you're someone who's bought stuff on margin and you're worried about interest rates. There's a small uptick in unemployment, just a tenth of a point, still the lowest in over 2 generations. This is confusing to the markets, as I've been saying and we've been feeling for the last 6 months. And it raises questions about whether the Fed will raise rates a quarter or half a point. Now, there are people going out on a limb this morning, going because of what's going on with the banking system and people's bond portfolios that support their core capital calculations, that the Fed will not raise in March or will only raise a quarter of a point. I think it's a legitimate thought, and to the extent that it helps equity markets, it might, but we don't know. We have to see what Fed governors start to leak out to the press in the coming weeks. So trading this week, I'm going to read this, which I usually don't do. If the banking sector remains unsettled, we may not put on new trades this week. Forgive me. This is a market neutral approach, but that doesn't mean we're market blind, market ignorant, or market stupid. And while cash every week always beats a bear. You have to be in and think like an investor and trade like a trader. The thinking like an investor beats a bear. The trading like a trader is how you get to beating the bear. We'll know a lot more with the Tuesday CPI report. So there's a whole muddle. And even if we don't trade tomorrow, we're going to get together. We're going to chat about this some more. We're going to review the market, review existing positions, and maybe there is a trade. Now, we got to look at the carry, like I said. The airlines held up reasonably well on Friday, and I think they will continue to. If they trade down, they'll trade down at a slower pace than the market is trading down. The home builders have been remarkably resilient in the face of effectively more than doubling of interest rates in a brief period, probably a year. And there's lots of my preferred home builder is DHI, but Toll Brothers is second. Lennar would be third, and KBH, and they're different, but they're the same. It depends upon which regions they're exposed to and what part of the market that they're catering to, and liquidity issues. And there was news today, this morning, which I'll get into in the live session tomorrow, about a major purchase by Pfizer of a company called Seagen, this $43 billion acquisition. Seagen has 4 approved, very 21st century. You'd think all cancer drugs are 21st century. These are cutting edge, and go in parallel to development efforts that Pfizer has in using a different approach to highly targeted oncology treatments. So Gilead has a very conservative choice in biopharma, but the whole sector may get a lift as people revalue companies. And they revalue companies based on what Pfizer, they're paying a 37% premium over market price for Seagen. So this is where we stand. I really look forward. I hope all of you who sometimes don't have the time, find the time for 20 minutes, half hour tomorrow to come to live trading as we discuss what's going on in the market. This is Michael Schulman, and really, thanks for listening.